Now this slide just compares, over that same period of time, it compares the price appreciation for the wealth building stocks versus government bonds, crude oil, home prices, and gold. And the wealth building stocks returned 60,000%, government bonds 204%, crude oil 176%. So you can see that these wealth building stocks outperformed other investments because, again, they have the ability to grow your equity. Now, another thing I discovered, that it's more profitable to own the wealth building stocks of companies that produce commodities than the commodities they produced. So what I did was I compared the profits for Valero Energy, Ultra Petroleum, and Suncor Energy versus buying crude oil. Now these are all wealth building stocks because they've been growing their equity at a high rate. I think for these three stocks the average growth was over 30%. And you can see that Valero returned 6,300%, Ultra 3,000, and Suncor Energy 3,400. And over the same period of time, if you bought crude oil, it returned 175%. So again, it's better to buy the stocks than the commodity itself. And here's a few more examples. The table on the top here is comparing the return for home builder stocks versus home prices. And again, these are stocks that have been growing their equity at a high rate, and which is a sign that their earnings are growing and their retained earnings are growing. So they returned a much higher profit than the homes that they built. And this is a comparison for gold mining stocks versus gold bullion. And again, it's better to own the stocks than the bullion. Now I got a couple examples here. This first one is National Oil Well, and it's over the past year the equity growth rate was 148%. 1 year return 181%. Apple, equity growth rate 48%, which is pretty high. 1 year return 123%. Here's a few more examples for Cameron and Precision Cast Parts. Now here's an example. Companies that have a negative equity growth rate. Tenet Healthcare had a negative equity growth rate of minus 42%, 1 year return of minus 63. Star Surgical, a negative equity growth rate and a negative return. Here's two more examples. Krispy Kreme donut and Midway Games. So this is a good measurement. If you're looking at a stock, it's a good measurement to see if the company's really growing or if there's really something to the company. And this is a real good indication of fundamentally whether you have a good stock or not. So I use this in combination with our trend following selection and trend confirmation, and this adds fundamental analysis to your trend following analysis.
Is there any way to scan for equity growth rate?
No, I wish there was. I just look it up manually. But I'm sure if you had a programmer program it, he could probably do that. But Google Finance and Yahoo Finance both have the equity growth figures for stocks. I usually look at the 3-year growth rate. Okay. And that gives you a good indication. I mean, if you use 10 years, that's better. That's a longer period, and that's better. But if you use the 3-year that you can get on Google, then that gives you a pretty good idea. To summarize, these are the general characteristics of companies with high intrinsic value growth rates. They have successful business models, unlike, let's say, the airlines, which don't have a successful business model. They have high earnings and sales growth rates. Their high profitability allows the company to retain their earnings. They have high profit margins. They have high cash flow levels and low debt levels. And again, the debt is always subtracted from the assets to compute the book value or the equity. So companies that have high debt levels and they spend a lot of money just servicing the debt are not going to be growing their equity. Or if they're capital intensive, like say the airlines are always having to buy airplanes, a lot of the earnings from the airlines just goes into paying for the airplanes. So they're typically not capital intensive businesses. Characteristics of companies with low or negative intrinsic value growth rate would be just the opposite. They have mediocre or poor business models, low or negative earnings or sales growth, low profitability, low profit margins, low cash flow levels, and high debt levels. And they're capital intensive businesses.